Your car just died. The repair bill is $600. You have $40 in your checking account. Your credit card is maxed. Payday is 6 days away. What do you do? You go to your bank's website. You apply for a small personal loan. The screen says, decision in 3 to 5 business days. 3 to 5 days? The tow truck is here now. You need cash today. This is where same-day loans enter the picture. 30 years ago, this meant driving to a strip mall, walking into a check cashing store, writing a post-dated check, and walking out with cash. It was fast, but it was local. Today? You don't leave your couch. You open an app, link your bank account, press apply, and money hits your account in hours. Sometimes minutes. But here's the question everyone forgets to ask: what exactly are you signing up for? Let's define the term clearly. A same-day loan is not one specific financial product. It's a category of credit where the time between hitting apply and the money settling in your account is compressed into a single business day. Technically, there are 3 settlement windows per day through the banking system: 7 a.m., 12 p.m., and 4:45 p.m. Eastern Time. Missed the cutoff? You wait for the next window. Product 2, the short-term installment loan. Newer fintech lenders offer this. You still get money today. But instead of one lump sum repayment, you pay back in monthly installments, 3 months, 6 months, sometimes 12 months. APR here is lower than Payday, usually 30% to 100%. Still expensive. Still higher than a credit card. But structured to avoid that single-day cliff. Product 3, the line of credit. This acts like a credit card. You're approved for a limit, say, $1,000. You only borrow what you need. You only pay interest on what you actually transfer to your checking account. As you repay, the credit becomes available again. APR here is the lowest of the 3, often 20% to 60%. Now, let's address the elephant in the room. Why are these rates so high? Banks won't lend you $300. It costs them the same paperwork to process a $300 loan as a $30,000 loan. The profit isn't there. So these lenders exist in a high-risk, high-cost space. Your credit score might be low. Your income might be irregular. You might have no collateral. The lender is taking a bet on you. That bet is priced into the interest rate. Does that make it fair? Not always. Does that make it illegal? No. Unless you live in a state that caps rates. And that's where things
A bank
get
will turn
complicated.
away from a small loan, even though the application is just as much work. A loan offers a safe path to profit, but a bet carries higher risk and demands a higher rate.
How do lenders approve you in 10 minutes with no human involvement? They don't check your history. They check your behavior. Step 1, you link your bank account. Services like Plaid or Argus connect the app directly to your transaction data. An algorithm scans the last 90 days. Step 2, the algorithm calculates 3 numbers. Average monthly deposits, your income. Frequency of deposits, are you paid weekly, bi-weekly, or random? Overdrafts, called NSF or non-sufficient funds incidents. Step 3, the scorecard decision. There is no loan officer. Your data runs through a statistical model. It returns a pass or fail in under 3 seconds. What about your credit score? Most of these lenders advertise no credit check. Technically, they perform a soft inquiry, it doesn't impact your FICO score. But here's the fine print: if you default, the lender can report your missed payments to the credit bureaus. Your score doesn't drop at the start. It drops at the worst possible moment after you've already failed to repay. Your legal protection depends entirely on where you live. Unlike mortgages, unlike federal student loans, small dollar lending is regulated at the state level. The same application could be legal with a 36% APR cap in one state, or legal with a 600% APR fee structure in the neighboring state. Look at this map. California, maximum payday loan is $300. Maximum fee is $45. Borrowers have 24 hours to cancel for free. Texas, no statewide APR cap. Fees are regulated through local ordinances. Rates vary wildly depending on your city. Illinois, the Predatory Loan Prevention Act caps rates at 36% APR. Traditional payday lending is effectively banned. Florida, maximum loan $500. Fees capped at 10% plus $5 verification. Approximately 304% APR. And a warning. Because laws vary, unlicensed lenders often advertise across state lines via text message or social media. If the lender is not registered with your state's Department of Financial Regulation, you have zero protection. Zero. So, what actually goes wrong? We analyzed consumer complaints and lender data. Here are the 5 fastest ways a same-day loan turns into a financial emergency. 1. Borrowing more than your income supports. Applying for $4,000 when your monthly net is $2,200. The algorithm catches this. Denied. 2. Multiple applications in 1 hour. 3 or 4 lenders in quick succession triggers hard inquiries if the lender performs them and signals credit-seeking distress. Denied. 3. Missing verification calls. Some lenders still call employers. If you're at work and miss the call, the loan is denied. 4. Ignoring the fixed repayment date. Payday loans don't flex. If your due date lands on rent day, you default. 5. State shopping. Trying to borrow from a lender in a state with looser caps while living in a restrictive state. Lenders verify your IP address and ID. Inconsistency equals rejection. Here's what this episode is not saying. We are not saying same-day loans are evil. We are not saying you should never use them. Emergencies are real. Sometimes the cost of borrowing is less than the cost of not borrowing. But you cannot make a good decision with bad information. In episode 2, we break down the specific types of same-day loans: payday, installment, title loans, lines of credit, and exactly how to identify which one you're being offered. Disclaimer: this content is for educational purposes only and does not constitute financial advice. Same-day loan terms, rates, and availability vary by lender, state, and individual credit profile. Information verified as of February 2026 but may change. Always consult with a qualified financial professional before making borrowing decisions. Some links may be affiliate links, if applicable.